Hey, welcome back. I'm Coben Juniper, author of the book Fake Bubble, which I wrote following my career as a founder and CIO of a billion-dollar multi-strategy hedge fund firm, which I had founded about 15 years ago. I put the link to the book below. Today, I want to talk about how private credit is repeating the worst mistakes of 2008. In 2008, the global financial system nearly collapsed because of financial products so complex, so opaque, and so riddled with hidden risk that almost nobody, not the banks, not the regulators, not the ratings agencies, truly understood what was inside them. We called them CDOs, collateralized debt obligations. And when they blew up, they took the world economy with them. Today, in 2026, a $3 trillion market called private credit is displaying almost identical warning signs. Same practices, same incentives, same opacity, different name. This is the story of how Wall Street learned nothing, and how ordinary investors are once again holding the bag. Let's start with the basics, because this stuff is deliberately made complicated. Private credit is essentially lending, but outside the traditional banking system. Instead of going to a bank for a loan, a company goes to a private credit fund. Think Apollo, Blackstone, Ares, Blue Owl. These are giant asset managers who pool money from investors, including increasingly ordinary retail investors, and lend it out to businesses, often smaller or mid-sized companies that banks won't touch. The pitch to investors was compelling: higher yields than bonds, low volatility, steady returns. And for a while, in a low-interest rate environment, it worked. The industry exploded from a niche corner of finance into a $3 trillion behemoth in less than 15 years. But here's what the pitch left out. These loans go to companies that couldn't get traditional bank financing, often because they're already heavily indebted or because their business model is shaky. And crucially, unlike stocks or publicly traded bonds, nobody prices these loans every day. The fund manager decides what they're worth, which creates an enormous, obvious, and largely unaddressed conflict of interest. Here's how this actually works, and I want to make this as simple as possible. Private credit flows into private equity. Private equity depends on leverage, on borrowed money, to generate returns. That money flows into commercial real estate, which is already struggling, not just because of interest rates, but because of fundamental demand problems. And commercial real estate debt? That sits on the balance sheets of regional banks. Pause. So you've got this chain: private credit, private equity, commercial real estate, regional banks. It's a domino run, and all it needs is a trigger. We knew this heading into 2026. I wrote about it, others wrote about it, and now, here we are. So what's going wrong right now? Three things happening simultaneously. First, defaults are rising. Morgan Stanley is warning that default rates in private credit could hit 8%. To put that in context, the historical average is 2 to 2.5%. The biggest reason? About a quarter of all private credit loans, 26%, went to software companies. And those software companies are now facing existential disruption from artificial intelligence. Unlike a factory or a building, software collateral can go to near zero almost overnight if the business model breaks. These loans have no floor. Second, investors are fleeing. In recent weeks, Ares, Apollo, BlackRock, Blue Owl, Cliffwater, and Morgan Stanley have all either gated or restricted investor redemptions. That means when investors asked for their money back, they were told no, or not all of it, or not yet. When that many major firms simultaneously block withdrawals, that is not a routine liquidity management measure. That is a slow-motion bank run. Third, the marks are fake. The Department of Justice has publicly warned about what it calls creative marks, meaning fund managers are valuing their loans optimistically, divergently, self-interestedly. The SEC is investigating ratings agency Egan-Jones for how it rates private credit products. When regulators start using words like creative marks and launch ratings probes, that is the sound of 2006 playing on repeat. Now here's where it gets truly alarming, because the structures being used today map almost perfectly onto what blew up in 2008. In the GFC, the weapon of mass financial destruction was the CDO, and worse, the CDO squared. Here's how it worked. Banks packaged risky mortgage loans into bonds. Then, they packaged those bonds into new bonds. Each layer of repackaging obscured the underlying risk, got a fresh rating, and got sold to someone new, until the whole thing collapsed and nobody knew what anything was actually worth. Today's equivalent has three components: PIK toggles. PIK stands for payment in kind. It means a borrower who can't afford to pay interest in cash just rolls the interest into the loan balance instead. The loan still looks performing on paper. It passes the fund's safety tests. It supports the fund's valuation. But the company is quietly drowning. This is the structural equivalent of the teaser rate mortgages in 2006. A mechanism for deferring visible pain while the underlying rot spreads. CLO securitization. CLO stands for collateralized loan obligation. Private credit firms are now packaging their loans into CLOs and selling tranches to pension funds and insurers at near-record pace, specifically to raise cash to meet redemptions. Let that sink in. They are securitizing stressed assets to fund investor exits. The buyers of those CLO tranches trust the ratings. The ratings are under investigation. BlackRock's private credit CLO has already breached its over-collateralization test, meaning the loans inside weren't worth what was claimed. The response wasn't transparency. It was a manager fee waiver, a procedural patch to keep the structure technically alive. NAV lending. This is the CDO squared of today. NAV stands for net asset value. Some funds are now borrowing money using the stated value of other private credit funds as collateral. Fund A borrows against Fund B. Fund B's value is set by Fund B's manager, who is paid more if the value stays high. You now have leverage on top of leverage with self-interested valuations at every single layer. Moody's has specifically flagged this as a hidden systemic risk for 2026. Almost nobody is talking about it. To be fair, and intellectual honesty matters here. This is not an identical replay of 2008. The leverage ratios are lower. There are no instruments with the full recourse that made Lehman's collapse so instantaneous and so catastrophic. But here's what the optimists are missing: the absence of mark-to-market accounting. The rule that forced banks to instantly realize losses in 2008 doesn't mean losses don't exist. It means they're invisible. And the alternative to a sudden crash is a slow bleed. Years of zombie loans. Credit quietly cut off to mid-market businesses. Pension funds steadily underperforming without a single dramatic headline to explain why. Damage spread so thin over so long that nobody is ever held accountable. That slow bleed may ultimately cause as much economic harm as a sharp crisis. It's just politically easier to manage, which is exactly why the reassurances keep coming. The people telling you this is fine, Goldman Sachs, Howard Marks, the fund managers themselves, are not neutral observers. They manage trillions of dollars in this market. They have every incentive to keep the confidence up and the redemptions down. What we know from the public record alone, the DOJ warnings, the ratings probes, the PIK toggles, the CLO stress tests failing, the redemption gates, the NAV lending, is enough to conclude that this market has the same behavioral fingerprints as the pre-GFC structured credit boom. The same incentives to obscure, the same mechanisms to defer, the same gap between what things are said to be worth and what they actually are. In 2008, they told us it was contained. It wasn't. History may not repeat, but right now, it is rhyming very loudly. If you want to go deeper on any of this, that's exactly what the book Fake Bubble is about. Link is in the description. Like this video if it gave you something to think about. Subscribe if you want to stay ahead of what's coming, and I'll see you in the next one.